Here's a crazy fact. A simple coin flip with a 1-to-1 risk-to-reward ratio outperforms 80% of retail traders. Really think about that for a second. If that doesn't make you question everything you know about trading, nothing will. Here's the setup. Imagine a trader that makes decisions by literally flipping a coin. If it's heads, they go long. If it's tails, they go short. They risk exactly $1 for every $1 they're trying to make. A perfect 1-to-1 risk-reward ratio. They have a stop-loss at -1 and a take-profit at +1. Every single time. No analysis, no indicators, no gut feelings. Just a coin, probability, and ironclad discipline. According to multiple studies, including data from major brokerages and academic research, this mindless, emotionless, completely random strategy would outperform more than 80% of retail traders. Let that sink in. 8 out of 10 people who spend hours analyzing charts, studying technical analysis, reading market news, and stressing over risk-to-reward ratios are doing worse than a quarter. Not because the coin toss is good, but because humans are that bad at handling uncertainty. This isn't just a funny observation. This is a psychological problem with huge implications that should completely reshape how you think about trading. Because if random entries beats most traders, then the problem isn't what everyone thinks it is. The mathematics of the coin toss strategy. Let's break down the numbers. With a true 50-to-50 coin flip and a 1-to-1 risk-reward ratio, the expected value of this strategy over the long term is exactly 0. Not positive, not negative. 0. If you flip a coin 100 times, you'll win approximately 50 times and lose approximately 50 times. If you risk $10 per trade, you'll lose about $500 on your losses and gain about $500 on your wins. You break even, minus trading fees and spreads, which might put you down a small percentage. So theoretically, our coin-flipping trader should hover around break-even over a large sample size. They shouldn't make money, but they definitely shouldn't lose money either. They're trapped in a mathematical purgatory of perfect equilibrium. Now what if you increase the risk to reward to 1-to-2 or 1-to-3? The result would be the same, net zero expected value. The win rate would drop proportionally to the increase in gain size, resulting in a break-even outcome. Here's where it gets disturbing. If this break-even strategy beats 80% of retail traders, that means the vast majority of traders aren't just failing a profit, they're actively losing money, doing worse than literal randomness with basic risk management. And they're losing it badly enough that doing nothing would be a significant improvement. Think about what this means. These aren't people who are breaking even. These aren't people who are slightly underperforming. These are people who are hemorrhaging capital so consistently that a zero-edge strategy would save them money. The average retail trader loses their entire account within the first year. Studies from various brokers show that between 75% and 90% of retail traders lose money. The ones who survive the first year often limp along, slowly bleeding capital until they eventually quit. Why the coin toss beats most traders. So let's understand why the mindless coin toss strategy outperforms the vast majority of traders. It's not about the strategy. It's not about the market analysis. And it's not about the RR ratio either. What destroys 80% of traders is that they lack the execution discipline to stick to their system through variance. Listen again, because this is the entire game. Execution discipline through variance. Variance is just a fancy word for the random ups and downs in your trading account that happen even when nothing about your strategy has changed. It's the natural noise in your results. It's winning streaks that make you feel like a genius and losing streaks that make you question everything. And here's the brutal truth. Variance is what separates traders who make it from traders who blow up. The coin flip has perfect execution discipline through variance. A human trader does not. And that difference is everything. The coin has perfect, unwavering, inhuman execution discipline. And this single factor is so powerful, so fundamentally important, that it compensates for having literally zero edge. The human problem. It's a fact that most human traders perform worse than random. You can literally flip a coin, execute the results mechanically. Completely random entries. Basic risk management. when rate automatically adjusts with whatever risk to reward ratio you choose, so expected value equals 0. And you will beat most retail traders. Not because the coin toss is good, but because humans sabotage themselves so consistently that they turn a positive edge system into a negative edge disaster. Trading isn't a math problem. It's a psychological endurance test through randomness. And this is where humans fall apart. This is where a quarter outperforms a trader armed with 3 screens and 7 strategies under his belt. Here's what actually happens to traders in real life and not on paper. Most traders abandon their systems during losing streaks. They'll take the first 3 losses, start doubting on the 4th, skip the 5th trade entirely, and by the 6th loss, they're looking for a completely different strategy. They never give their system a chance to reach its expected value because they can't tolerate the randomness. Most traders take impulsive trades outside their plan. They lose 3 in a row and suddenly they're revenge trading, scanning every chart, forcing setups that don't exist, just trying to get back to even right now. Every emotional trade chips away at their edge. Most traders let emotions dictate timing and position size. They feel confident, so they risk more. They feel scared, so they risk less or skip trades entirely. Their emotions are making their trading decisions, not their system. All of this turns a 0 expected value framework into a negative expected value behavior loop. The problem isn't their analysis. It's not their strategy. It's not even the market. The problem is variance intolerance. They can't handle randomness, so they distort their own edge and risk management into guaranteed loss. Now look at what the coin toss doesn't do. It doesn't get scared after a losing streak. Flip number 47 gets executed exactly the same as flip number 1, regardless of what happened in between. It doesn't revenge trade. There's no ego to bruise, no frustration to manage, no emotional need to make it back. It doesn't skip valid trades or overtrade. Every signal gets taken. No signals get added. The sample size stays pure. It doesn't second-guess signals. There's no, maybe I should wait for more confirmation, or this one doesn't feel right. The flip is the signal. The signal gets executed. The coin toss executes mechanically, every time, like a casino would. And that consistency alone means its realized expectancy stays around 0. Meanwhile, human traders' realized expectancy drifts below 0 due to emotional interference. Here's what happens after 1,000 trades. The random entry, 1-to-1 coin toss system, finishes at near net 0 expected value before fees. The human trader, who cuts winners, widens losses, skips setups, and revenge trades, they end around negative 0.4 risk units per trade. The coin toss wins, not because it has an edge, but because it preserves neutrality while humans destroy theirs. And here's the real lesson. The gap between mathematical edge and realized edge is execution discipline through variance. In other words, your ability to stick to your trading rules through big drawdowns is what determines whether you can actually capitalize on your trading plan. And clearly, humans are terrible at trading through randomness. You can backtest a system that shows plus 0.5 risk units per trade over years. But if you can't execute it without flinching during drawdowns, your actual realized edge might be negative 0.2 risk units. The math says you should win, but your psychology ensures that you lose. That's why even a dumb random system beats 80% of retail traders. Not because it's smart, but because it's emotionless. It's not the market that kills traders. It's traders' inability to execute through randomness what kills traders. The market is just noise with some edge buried in it. The coin toss can survive that noise. But humans, with their fear after losses, their greed after wins, their impatience during drawdowns, and their ego refusing to follow the plan, they turn that noise into a meat grinder. The illusion of technical complexity. There's a seductive belief in trading that complexity equals profitability. Traders think that if they just learn one more pattern, add one more indicator, understand one more concept, they'll suddenly become profitable. This is the technical analysis trap. And it's a trap that the education industry loves because it keeps you buying courses, watching videos, and chasing the next secret. Here's the truth. Technical analysis, past a very basic level, has diminishing returns that approach zero. Does price action matter? Yes. Support and resistance are real. Trend direction is real. These concepts work because they're based on the actual behavior of market participants. But do you need to understand the difference between a bearish Gartley and a bullish butterfly harmonic pattern? Absolutely not. Do you need to know every Fibonacci ratio? No. Do you need to analyze market structure on 6 different time frames before entering a trade? No. The obsession with technical complexity is a form of intellectual procrastination. It's easier to study charts than it is to face the psychological demons that actually prevent you from being profitable. I've seen traders who can identify every single chart pattern in existence, but they can't take a loss without their hands shaking. I've seen traders who can explain the nuances of order flow, but they can't resist checking their trades every 5 minutes. I've seen traders who understand advanced statistical concepts, but can't stop themselves from doubling their position size after a losing streak. The technical knowledge isn't the problem. The execution is the problem. Think about it this way. If I gave you a strategy right now that had a genuine edge, let's say it wins 55% of the time with a 1-to-1 risk-reward ratio, could you trade successfully? On paper, you'd think, of course. 55% win rate with 1-to-1 ratio? That's profitable. I just take every signal. But would you actually? Would you take the trade after you had 3 losses in a row? Would you risk the same amount on trade number 50 as you did on trade number 1? Even if you were down 15% at that point? Would you avoid taking revenge trades after a frustrating loss? Most traders can't. That's why they lose. And this brings us to one of the most important concepts in trading: the difference between a trading edge and a trader's edge. A trading edge is a strategy with positive expectancy. It's a statistical advantage in how you analyze and enter markets. A trader's edge is your ability to execute that strategy without sabotaging yourself. You can have the best trading edge in the world, but without a trader's edge, you'll lose money. Meanwhile, you can have a mediocre trading edge or even a random coin flip. And if you have a strong trader's edge, you'll outperform the majority. This is why discipline, emotional control, and consistency are not secondary skills in trading. They're not something you develop after you've mastered technical analysis. They're the primary skills. They're the only skills that actually matter in the long run. Now here's where it gets even more brutal: higher risk-reward ratios. Everything we just talked about, execution discipline through variance, gets exponentially harder as you increase your risk-reward ratio. A 1-to-1 risk-reward coin toss has roughly 50% win rate. You win some, you lose some. The feedback comes relatively fast, and the psychological load is manageable. But what happens when you move to 1-to-2? Now your win rate drops to around 33%. You're losing 2 out of every 3 trades. Can you handle that? Can you take 10 trades, lose 7 of them, and still execute trade number 11 with the same conviction and position size? What about 1-to-3? Now you're winning maybe 1 in 4 trades. 25% win rate. That means you could easily hit streaks of 4, 5, 6 losses in a row and still be well within normal statistical variance. Your system isn't broken. This is just what randomness looks like at 1-to-3. And this is where traders break. Because in the middle of that 6-loss streak, you don't know if the next trade is going to be another loser. You don't know if you're in a normal drawdown or if the strategy has stopped working. You don't know if you should keep trusting the process or if you should change something. The psychological load of sustaining a low win rate strategy is immense. It requires an almost superhuman level of emotional control and conviction. Here's the psychological reality. The higher your risk-reward ratio, the lower your win rate, and the longer your losing streaks will be. That's not a bug. That's mathematically guaranteed. You're trading higher variance for higher rewards per win. But higher variance means longer periods where you're wrong. Longer drawdowns. More consecutive losses. More time spent watching your account bleed while you wait for that one big winner to make it all back. Sure, your winners are bigger, but they're few and far in between. And every single loss in that streak is a test of your execution discipline. After loss number 3 at 1-to-3, you start thinking, maybe I should take some profits earlier. So you exit the next winner at 1-1 instead of 1-3. Congratulations, you just destroyed your edge. Your system needs those 1-3 winners to overcome the 75% loss rate. By cutting it short, you've turned a profitable system into a guaranteed loser. After loss number 4, you think, maybe I should skip the next trade, just wait for a better setup. But there is no better setup, it's a coin toss. Every setup has the same probability. By skipping, you're just gambling that the next trade would have been a loser. Sometimes you'll be right. Sometimes you'll skip the winner you desperately needed. Either way, you're no longer executing your system. After loss number 5, you're convinced the system is broken. You abandon it entirely, right before the natural statistical regression brings you back. You never see the 3 winners in the next 5 trades that would have put you back in profit. This is why higher risk-reward ratios destroy most traders. Not because the math doesn't work. The expected value is the same whether you trade 1-1, 1-2, or even negative risk to reward. A coin toss at any ratio still has 0 expected value theoretically. But the psychological load from increased volatility is completely different. At 1-1, you win half the time. The feedback loop is tight. You can see your system working regularly, so long as you have a small edge, even if it's just randomness. At 1-3, you lose 3/4 of the time. The feedback loop is brutal. You can go weeks feeling like a complete failure, even when you're executing perfectly and just experiencing normal variance. Most traders cannot handle the variance. They will modify their behavior. They will sabotage themselves. And they will turn that 0 expected value into deeply negative realized returns. So what's the lesson here? If you can't execute a 1-1 strategy with perfect discipline through variance, you have absolutely no business trading a 1-2 or 1-3 system. Your risk-reward ratio needs to match your psychological tolerance for variance. Not what sounds cool, not what the gurus say is optimal, what you can actually execute without breaking. This means not forcing yourself to stick to one specific ratio just because someone on YouTube said so. Now, I'm not saying that a 1-1 is the only one that works. If your temperament allows for longer losing streaks in exchange for bigger wins, a 1-2 or 1-3 might suit you. But for the majority of people, and especially beginners, a 1-1 will help greatly in keeping your emotions in check. What actually matters? The profitable trader's mindset. So if technical analysis is overrated, and if strategy is less important than everyone thinks, what actually matters? It all comes down to execution discipline. This means the literal ability to take every signal your strategy generates without hesitation or modification. When your strategy says trade, you trade. You don't skip trades because you're scared. You don't take trades that aren't signals because you're bored. You don't adjust your stop loss after entry because you want to give it more room. You follow the plan exactly every single time. The coin flip has perfect execution because it has no choice. It can't second-guess itself. It can't get creative. You need to develop that same mechanical consistency. And this ties directly into risk management, which isn't just about having a stop loss. It's about risking the same amount on every trade, regardless of how you feel. Not 1% when you're confident and 0.5% when you're nervous. 1% every trade. No exceptions. This also means never risking so much on a single trade that a loss would emotionally devastate you. If losing 1% of your account makes you angry or anxious, you're risking too much. If the amount bothers you, you need to risk less. But here's where it gets really difficult. Emotional neutrality. This is the ability to view trading as a probability game where individual trades are completely meaningless. Wins and losses are just data points. They don't define you. They don't prove or disprove your intelligence or worth as a person. The coin flip is emotionally neutral because a coin can't feel anything. It doesn't celebrate heads or mourn tails. It just flips and moves on. You need to develop the psychological tools to respond to wins and losses the same way the coin does, with complete indifference. And this requires long-term thinking, which almost no one has the patience for. If your strategy has an edge, you need 500 or 1,000 trades to see it clearly in your results. But most traders give up after 50 trades or 30 trades, or sometimes even 10 trades. They hit a rough patch and decide the strategy doesn't work. The coin flip doesn't give up. It doesn't get discouraged. It keeps flipping because that's what it does. You need that same persistence, that same commitment to seeing the process through regardless of short-term results. All of this culminates in process over outcomes. This is your ability to judge yourself on whether you followed your rules, not on whether you made money today. A perfect trade that loses money is a success. A sloppy trade that makes money is a failure. Most traders have this backwards. They think the outcome validates the decision. But in a probabilistic game, you can make a perfect decision and lose, or make a terrible decision and win. The outcome of any single trade is just noise. What matters is whether you executed your process correctly. The coin flip represents pure process. The outcome is completely random, but the process is perfect every single time. That's the mindset you need to cultivate. These skills, execution discipline, risk management, emotional neutrality, long-term thinking, and process focus, are the actual skills of trading. They're not taught in most trading courses because they're not sexy. They don't make for good YouTube thumbnails. You can't sell them as easily as the secret pattern institutions don't want you to know. But they're the actual difference between the 20% who make money and the 80% who lose. Here's the message that most traders don't want to hear. You are the problem. Not your strategy. Not your risk to reward. Not the market. Not the brokers. Not the algorithms or institutions or market makers. Your inability to control your emotions. Your need to be right. Your impatience. Your fear. Your greed. Your lack of discipline. Your inconsistency. A coin doesn't have these problems. That's why a coin can beat you. But here's the good news. These are solvable problems. Unlike trying to predict the future or outsmart institutional traders with billion-dollar technology, fixing your psychology is actually possible. It requires self-awareness. It requires brutal honesty. It requires treating trading as a performance discipline similar to sports or music, where your mental game is just as important as your technical knowledge. The coin flip thought experiment isn't meant to suggest that you should actually trade with a coin flip. It's meant to shatter your illusions about what matters in trading. It's meant to show you that trading is more about execution discipline, both in your strategy and risk management, than prediction. It's about your ability to be consistent in the face of uncertainty, to be disciplined when emotions are screaming at you, to be patient when results are slow to materialize. The successful traders, I know, aren't the ones with the most complex strategies or the most advanced technical knowledge. They're the ones who could do the same boring thing every day for years without breaking. They're the ones who treat trading like a business. They're the ones who've developed a trader's edge. So stop looking for the perfect strategy. Stop obsessing over whether you should use Bollinger Bands or Keltner channels, whether you should trade the 15-minute or the 1-hour time frame, whether you should use a trailing stop or a fixed stop. Instead, ask yourself these questions. Can I execute a simple strategy with 100% consistency? Can I risk the same amount on every trade without adjusting based on my confidence level? Can I take a loss without feeling angry, anxious, or compelled to make it back immediately? Can I take a win without feeling invincible or getting overconfident? Can I survive a 6-trade losing streak without questioning everything? Can I focus on my process instead of my profit and loss? If you can't answer yes to all of those questions, then your strategy doesn't matter. You could have the best strategy in the world and you'd still lose money. But if you can answer yes to those questions, you don't need a perfect strategy. You could trade something incredibly simple. Hell, something barely better than a coin flip, and you'd probably beat 80% of retail traders. Because at the end of the day, trading isn't about predicting the future. It's about managing yourself. It's about building a psychological fortress that can withstand the randomness and chaos of the markets without crumbling. The coin doesn't try to predict the future. It just flips. And it flips with perfect consistency, perfect discipline, and perfect emotional neutrality.